Okay, so we're looking at exercise 10.24, and we are looking at parts B and C. And we'll go ahead and figure out how to do these last couple parts. So you recall that we had a machine that at 12/31/2020 had a cost of $1.3 million, accumulated depreciation of $360,000, and a net book value of $940,000. On April 1st, 2021, we sold the machine for $1,040,000 to Yoakum Company. So what do we have to do in order to record this disposal? The first thing we have to do, which is what we always have to do, is we have to update depreciation. So what do we know about depreciation? We know it's $60,000 per year. We're given that here. April 1st, 2021, how many months of depreciation do we have to record from 12/31/2020, January, February, March, 3 months. April 1st, the beginning of April, so we have 3 months, 3, 12, so we can do plus 60,000 times 3 divided by 12. So $15,000 is our amount of depreciation expense. So depreciation expense and accumulated depreciation. So that's our journal entry to update depreciation. And we're also going to add our $15,000 of accumulated depreciation to get $375,000 is our balance for 1/2020, and here's our balance. Now, disposal of the machine. How do we record the disposal of the machine? So remember what our recording of a disposal of an asset needs to do. We have to take the asset off the books, have to take the accumulated off the books, we have to record our consideration, and the rest is gain or loss. Let's go ahead and calculate our gain or loss. So on this disposal of the machine, what was our consideration received? So we got cash of $1,040,000. We've got to subtract our net book value. So what's our net book value? Our cost is $1.3 million, and our accumulated depreciation is $375,000. So our net book value is $925,000. And so if we have a net book value of $925,000 and we got cash of $1,040,000, then we have a gain of $115,000. All right, so we know that we've got a gain, and we now know all the pieces, parts for our journal entries. So we're going to record, and again, I'm not doing these particularly in good form, I'm doing these in good logical form. So we have to take the machine off our books, and that's going to be $1.3 million. We have to take the accumulated depreciation off our books, and that's going to be the $375,000. We have to record the consideration received, and that's the cash of the $1,040,000. And then we've got the rest as a gain. Remember, gains make our income statement happy, credits make our income statement happy, and so we're going to record the gain of $115,000. And we've got total debits of $1,415,000, total credits of $1,415,000 in our journal entry balances. So this is 10.24 Part B. Now, let's look at 10.24 Part C. Always updating depreciation. So let's look at, we got the same machine on July 31st, 2021. Instead of burning it in a fire or selling it to Dwight Yoakum, we are going to donate the machine to the Mountain King City Council. Why we are making donations to a city council, I don't know. Let's assume that it's for the purpose of adding to the vocational ed in the school, and not for the purpose of bribing city council members. So we're making a donation to the city council for the schools. The fair value of the donation was estimated to be 1.1. Okay, so this is going to be a bit of a weird thing. The first thing we will have to do is normal. We will update depreciation, because how often do we update depreciation? That's right, always. So we have to update depreciation. Then we have to record the disposal of the machine. We'll think about what that is when we get there. So let's take depreciation. $60,000, July 31st, 2021. How many months have passed? So we've got January, February, March, April, May, June, and July have all passed. That is 7 months. So 7, 12. So 60,000 times 7 divided by 12 is $35,000. That's our depreciation. Now you might notice, by the way, that instead of typing numbers in here, I put the numbers in separate cells, and all I have in here is formulas. I think that's a better way to use Excel than to, do 60,000 times 7 divided by 12 and put it in the cell. I like to show out all the math I'm doing, mostly so other people can look at my spreadsheets and see what I've done. It's a lot cleaner that way. But that's an aside. That's my unsolicited career advice for the day. So let's update depreciation. Depreciation expense, $35,000, and accumulated depreciation, $35,000. Updating depreciation doesn't just mean we make a journal entry, but we actually put in the T account. So that's our journal entry. Here's our T account. All right, so this is 7/31/2020, and here's our balance. All right. Record disposal of the machine. So we got to record our gain or loss. So here's a little bit of a weird thing. We donate the machine, we get nothing in exchange. So you could say that the way to think about it is, what's our consideration received? And we got, 0, because we got nothing for the donation. Less net book value. And you got the cost of 1.3 million. We've got our accumulated depreciation of $395, and so our net book value is a $905,000 net book value, and then we have a loss of $905,000, and that makes perfect sense. Except what we get here is actually the benefit of having made a $1.1 million donation. Another way to so one way to think of it is, we got whatever goodwill from the schools, from the city council, from the community, from whatever, of having made this donation. So we got the same benefit as if we'd given $1.1 million of cash. You can also think of it as, we're kind of pretending like we're selling it for $1.1 million and then donating the cash. A principle here, if you think about how you value something, you value an asset based on the fair value of what was given up or what was received. In this case, we're going to take it off the books at fair value. So instead of a $905,000 loss, we are going to have, if we take it off the books at $1.1 million, we have a $195,000 gain on the disposal of the asset. Now, I'm going to write this other number down here just to remember this number, to show you how the whole world makes sense. At least this part of it. A lot of it doesn't. So, how are we going to do this? So we've got a gain of $195,000. What we're going to do here is, we are going to take the machine off the books in our journal entry at 1.3, take the cost off at the cost. We're going to take off the accumulated depreciation of $395. We're also going to record the gain at $195, and so now we've got $1,495,000 of credits. We only have credits. We only have $395 of debits, and we're going to record contribution expense And this gives us the benefit of whatever goodwill or public relations benefit or wherever we might have gotten. We got $1.1 million of benefit for the contribution. So our income statement will show that we contributed $1.1 million because that's the fair value of the machine. Our gain is $195. If we take these two things together, so our income statement goes down by $1.1 million, and then it goes up by $195. A gold star, if you can guess what the sum of these two numbers is, it's a net loss of $905,000, which is the same thing we have here. So what that means is we had an asset that was on the books at $905,000. That asset goes away. We got no other benefits. We got no other assets in exchange. So if you think about assets equal liability plus equity, assets goes down $905,000. Equity's got to go down by that same $905,000. But our income statement now shows that we had a $1.1 million contribution, which really reflects what went on, sort of an economic fair value sense. And our financial bookkeeping sort of has to be adjusted because we depreciated the asset in a sense too much. And so we got recapture some of that with the gain. This is a bit of a weird scenario. This is not the most common thing. The donation of a machine is much less common than selling it for cash, which is part B, or getting some other kind of cash settlement, which is part A. So you don't need to know all these intricacies, but I did want you to at least see this principle of fixed asset transactions happen at their current fair value at the time of the transaction. That's what's going on here.